You've probably seen a headline like this floating around: Bitcoin to $200,000 in just a few weeks. It's a pretty wild claim, right? But is it a real forecast, or is there something else going on behind the scenes? Well, that's what we're going to dig into. We're going to break down what's really behind this prediction.
And there it is, the exact quote from market analyst Tom Lee that got everyone talking: 200K in the next 50 days. I mean, just let that sink in for a second. He's not talking about some slow, steady climb over a year. He's calling for a massive rocket ship rally in less than 2 months. So to put that $200,000 number into perspective, Bitcoin's price would have to do more than a 2x in a ridiculously short amount of time. A move of that size that fast would be completely historic. We're talking about something unprecedented in the financial markets. So, what would a rally like that actually mean for the market? Well, for years, a lot of traders have relied on Bitcoin's pretty predictable 4-year cycle, which is all tied to its halving events, when the supply of new Bitcoin gets cut in half. A 200K price this quickly, it would completely shatter that pattern. It would basically mean throwing out the entire playbook that everyone's been using. Okay, but here's where the story gets really interesting. There's a major twist. Around the same time he dropped this super bullish Bitcoin prediction, Tom Lee had a very, very different take on the rest of the market. And this contradiction is where our investigation really kicks off. I mean, it makes you wonder, right? If an analyst is predicting this kind of risk-on explosion for a speculative asset like Bitcoin, what do you think they'd say about the stock market? You'd assume they'd be incredibly bullish on, well, everything, wouldn't you? Well, not exactly. So on one hand, you have Lee calling for Bitcoin to more than double in 50 days, and on the other hand, he's forecasting a 10 to 15% drop for the S&P 500. Those are two completely opposite views on market risk coming from the same person at the same time. It's a total head scratcher. It just doesn't add up. So how do we make sense of this? To figure it out, we really need to look beyond the charts and start looking at the incentives. When a prediction seems this contradictory, the best framework is usually the simplest one: follow the money. And in this case, Tom Lee isn't just some random guy with an opinion. He has a very specific public role with a company, BitMine, that has a direct vested interest in making the crypto market look as good as possible. A huge part of BitMine's strategy is to basically act like a treasury, holding and buying crypto. So you can see their success is directly tied to crypto's value and, maybe more importantly, its public perception. So here's the crucial point. His job as the public face of this company is essentially to be crypto's biggest cheerleader. He needs to keep that bullish sentiment high to help the company bring in investors and just survive the brutal bear markets. His paycheck is likely tied more to being that consistent optimistic voice than to being right on every short-term price call. Now, this quote, it's actually from a parody video, but it gets to the absolute heart of the matter. You know how the best jokes often have a little bit of truth in them? Well, this one frames his public persona perfectly. It's a job he's paid to do, and that job is to be relentlessly positive. And listen, this isn't just a story about one analyst. It's a perfect example of a much bigger pattern you see all over financial media, something we can call the talking head trap. So what is that? It's the danger of basing your financial decisions on the loudest person on TV or on social media. Following these big predictions without a solid plan of your own is a one-way ticket to Wreck City. And trust me, that's crypto slang for getting completely wiped out financially. And this pattern is everywhere once you start looking for it. A perfect case study is Cathie Wood and her Arcake Innovation Fund. For a couple of years, she was an absolute rock star in the finance world, constantly making these super bold predictions. The hype was just off the charts. But what was the reality for the people who actually bought in? The numbers here are just staggering. Since its peak back in 2021, the ARKK fund is down about 50%. During that same period, a simple, boring S&P 500 index fund is up about 50%. That is a massive 100-point performance gap. It's just concrete proof that following the loudest hype can lead to some of the worst results. Okay, so we've seen the problem, and it's really easy to get cynical about all this, but that's not the goal here. The goal is to build a smarter way to approach the market. So how do we tune out all that noise and actually focus on what works? All right, here's a key distinction to make. Being a permabull, being permanently optimistic, can work out really well for broad market indexes like the S&P 500 or even Bitcoin over a very long time horizon. History shows they tend to go up. But that same thinking is incredibly dangerous when you apply it to individual speculative assets, which can easily drop 90% and just never recover.
So, what does a smarter strategy look like? First, focus on the trend, not the talk. What is the price actually doing? Second, use objective data, like simple moving averages or volume trends, to define the market without getting all emotional. And finally, and this is the most important one, don't trade based on hype. Never build a strategy around the predictions of some media personality.
And that really brings us to the core message of this whole explainer. The goal is never to perfectly predict the future. Nobody can do that. The real goal is to have a system, a process, that protects you from all the noise so you can act on the real signal.
We broke down this one headline, but there's going to be another one tomorrow. The media is a constant fire hose of hype. So the question I want to leave you with is this. What is your system for finding the signal in all that noise? Because at the end of the day, being an informed, critical investor is the only real edge you have.